This question comes from Michael Liu from California. This is for both Warren and Charlie. In your shareholder letter, you mentioned that the best investment results come from the companies that require minimum assets to conduct high-margin businesses. In today's world, many of these companies tend to be software-driven businesses. While Berkshire has avoided investing in high-growth technology companies in the past, this appears to be slowly changing with your investments in Apple and Snowflake. As shareholders, should we expect that high-margin businesses will begin to constitute a larger proportion of Berkshire's investment portfolio over time, particularly as Todd and Ted take on larger roles in the investment decision process?
Well, we've always known that the dream business is the one that takes very little capital and grows a lot. And Apple and Google and Microsoft and Facebook are terrific examples of that. I mean, Apple has $37 billion in property, plant, and equipment. Berkshire has $170 billion or something like that, and they're going to make a lot more money than we do. They're in better business. It's a much better business than we have. And so in Microsoft's business is a way better business than we have. Google's business is a way better business. So we've always we've known that a long time. We found that out with See's Candy in 1972. I mean, See's Candy just doesn't require that much capital. It doesn't have, it has obviously a couple of manufacturing plants, they call them kitchens, but it doesn't have big inventories except seasonally, for a short period. It doesn't have a lot of receivables. So those are the kind of businesses. They're the best businesses, but they command the best prices too. And there aren't that many of them, and they don't always stay that way. So we're looking for them all the time, and we've got a few that are pretty darn good, but we don't have anything as big as the big guys. But that's what everybody's looking for. That's what capitalism is about, people getting a return on capital. and the way you get it is having something that doesn't take too much capital. I mean, if you have to really put out tons and tons of capital, the utility business that way, it's not a super high return business. You just have to put out a lot of capital. You get a return on that capital, but you don't get fabulous returns. You don't get Google-like returns, or anything remotely close to it. We're proposing a return in the transaction with the proposition with Texas. I think it's a 9.3%.
Yeah, 9.3.
Yeah, and But if you look at the return on most American businesses on net tangible assets, it's a lot higher than 9.3. But they aren't utility businesses either.
Charlie, did you want to add anything to that?
No,